So what are ways to invest in the stock market? In this video, I'm gonna go over 5 different ways on how to invest or trade in the stock market. Hey, how's it going? On this channel, we talk about stocks and options with the idea of allowing you to maintain a full-time job or trade as a full-time job. So if you're new here, consider subscribing. And today, we're talking about basic stock market investment strategies. There are infinite ways to trade or invest and make money in the stock market, but there's a few major time frames of really how you trade using those. And what I mean by that is, number one would be value investing. And what that is just buying a stock and holding it with the idea of holding it for 5+ years or maybe forever. And this is kind of the Warren Buffett strategy of stocks will always go up over time, especially if you pick a good one. And an example of that right now could be Amazon. The idea is, Amazon is, I don't really see Amazon ever doing bad in the long run. It's just growing and growing. And that could be an example of a value investment. The next strategy being long-term investment strategy. And the idea behind this is the outlook of the company for the next 1 to 5 years is pretty strong, but maybe in the future it's not, beyond that it's not profitable. Like, let's say like a fad or something. Like if I thought Snapchat was maybe going to be around for a while, but wouldn't be something like Amazon that I believe that it's going to be around for forever. And so maybe I would invest in that for the next few years, and as I saw it start to dwindle and maybe not look as profitable, I would move my money elsewhere for a better looking investment. Usually with these two strategies, it's generally based off of fundamentals of the company, how the cash flow and balance sheets are doing, compared to looking at the stock price or a stock chart and making an investment plan off of that. The next strategy would be a medium-term investor, and that would be anywhere between a few months to almost a year. And this could be based off of either stock charts or price action or fundamentals of a company, and if you think that they're going to produce good results financially over the next year, that will increase the stock and it's a profitable investment to make. And now we're getting into really short time frame, short-term trader, 1 to 3 days. That is generally only off of stock charts or price action. You can't really judge what a company is going to do in the short term like that based on financials of a company, because short-term price action or what a stock does over the short term is really based on what investors think and what they feel, if they want to buy a stock, or if there's some news article that comes out and people get really frantic and rush to buy or sell a stock, that can really drive price a lot more, even though maybe the company is doing really well financially, but that takes a lot longer time to affect the price of the stock. With the last time frame being a day trader, and these people will be buying and selling stocks throughout the day. They won't be buying it and holding it for the long term. They will just be buying it with the idea of trying to catch a couple points in a move throughout the day to make just a few bucks, and they'll be doing this all day every day, or maybe just for a few hours a day. A big difference between these shorter term time frame traders compared to the long term or value investing traders is the value investing traders, they will generally only be buying stock or shares in a company, compared to the shorter term or day traders. They will be using a lot of different assets, either options, stocks, or futures. One of the most common ways to invest either long term or extremely long term in the stock market is through stock portfolios. And the idea behind these is, instead of putting all your money in one company and risking all your money on that one company, in case that company either went bankrupt. You don't want to lose all your money. And the idea of these is to spread your money out over different companies and different sectors of the market to spread your risk and diversify. An example of that would be you have a $10,000 portfolio and you have 33% in tech, which would mean you have 33% of your money, so $3,300 invested in tech companies. And so examples of those could be like Google or Microsoft. And the idea of having your investment split among different parts or different types of companies is there will be periods of time where certain industries in the market will do either really well or really poorly. And it's just another way to diversify yourself so you don't have only tech companies, and if there is a tech crash, your whole portfolio would crash. But if you had just some tech, that would mean only some of your portfolio went down. And usually when a part of the market does bad, another part of the market is doing good because the money is rotating out of that sector into another sector. And that could be something like financials. And so another idea is you would have 25% of your portfolio in financials, and you could be buying banks such as Bank of America or JP Morgan and Chase. And there's a ton of different sectors. These are just another few examples, either industrials, utilities, or energy. And that's just how you generate a diversified portfolio. And there can be 10 to 100 stocks or even more in one portfolio. When I first started looking at this stuff, I thought it was pretty daunting to try and pick 20 to 100 different stocks to try and make a diverse portfolio. And the nice thing is there are companies out there that make essentially pre-built portfolios, which are called mutual funds. And they're many different types. They can vary from making aggressive account returns or being a target retirement fund, and they can just have just about anything in them, but they are very useful for trying to make yourself diverse without having to put the time and effort into researching so many stocks. The next type of fund is a index fund, and what these do is instead of buying a portfolio of stocks in any way, they buy stocks that match a stock market index. And this could be the S&P 500 stock market index, which is one of the major stock market indexes. And the idea is that this fund would get the same return as that stock market index. And how they do this is by weighting each stock the same amount as it is weighted in the index. So for example, if Google is 1% of the S&P 500, the stock market index portfolio would have 1% of their money allocated into buying Google shares. The idea behind this is mutual funds can get good returns or bad returns, and index funds will always get the return that the stock market gets, and that can generally be seen as good returns if you're matching the stock market. The only problem with both of these kind of funds is that they do have fees in them. Mutual funds generally have more than index funds because index funds are much more passively managed compared to mutual funds they're not always actively managed, but they definitely take more management to do than index funds, which makes them cost more money. And these fees, they may seem really small and fractions of a percent, but they do add up over the long term. If you're planning to hold one of these for 10, 20, 30 years, it equates to a lot of money you missed out on. So it's just something to keep in mind. But they are getting a lot better about having smaller and smaller fees. A good website to go and look at a lot of these kind of mutual funds or index funds is Vanguard. They have a ton of really good low fee index or mutual funds if you were looking to go that type of investing route. Strategies for the shorter time frame can seem a lot more complex, just based on the fact that there's so many different ways to make money in the stock market that the more shorter time frame caters to. You can do it in the longer time frame, but it just doesn't work as well. And a lot of these would be buying options or buying futures or buying forex as well. And you don't really have to know what those are right now. They're just other ways to trade financial assets in the stock market, much like buying a stock. But for the shorter time frame, you generally need good knowledge of either fundamentals or stock charts to make investment strategies or plans. And you don't necessarily need a whole stock portfolio to buy stocks in the more shorter time frame. If you see that one stock is going to do really good, you could buy all your money into that one stock, and it could do well every time for you because you know what you're looking for and you have a strong strategy for picking a winning stock. And that is how a lot of people still make their money. You don't have to go the typical make a stock portfolio or buy a mutual fund or investment fund route. You can learn how to trade or invest in the stock market yourself and use these strategies to make money in the long term or short term. Hey, thanks for watching the whole video. If you want to learn more about stock trading or picking stocks, make sure to subscribe. I'll be coming up with a lot more videos on reading stock charts and being able to make an educated guess on where a stock is going to go. If you have any burning questions, ask them in the comments below, and I'll see you next time.